Hello, my name is Justin Byram. I'm part of the Lighthouse Wealth Management team, and I'm here today to talk to you about inflation, interest rates, and how rising and falling rates impact the markets. So you'll likely hear a lot of pundits debating, and you'll see a lot of headlines come out over the next few days regarding the Fed's recent meeting where Fed Chairman Jerome Powell hammered home that he would not be raising short-term interest rates anytime soon. However, despite this clear message from Powell, we saw the 10-year Treasury hit 1.74% Thursday morning, a vast increase from the 1.3% it sat just 1 month ago. So the big question that we want to answer today is, why do large growth stocks think Google, Amazon, Apples of the world prefer lower interest rates? And the answer is one of simple mathematics. So when these large growth stocks provide earnings and guidance, we have a few things that we want to evaluate: dividends, earnings, and earnings growth rate. So starting with dividends, with these type of large growth stocks, you can pretty much throw dividends out the window. These type of stocks, rather than paying you a dividend today, they would rather take all of their earnings, profits, and any access to capital, and they will invest it into new products, innovation, and improving their current products. And the thought process there is they'll provide greater value over long-term stock price appreciation rather than paying a dividend to shareholders directly today. So with these type of large growth companies, dividends just don't come into play very often. So that leaves us with growth and a growth rate to consider. So one thing that we need to keep in mind with these type of growth stocks is that the majority of their projected earnings and revenues will happen far out into the future. So it'll happen in many years from now. And that causes a couple of things that we need to evaluate. So when interest rates rise, when these type of companies have to discount their projected revenues back to today's dollars, that interest rate increases the discount rate, putting a dent in those potential future earnings. And as you would expect, the opposite is also true. When interest rates are lower, the discount rate is lower, so that figure becomes larger in today's dollars because you have to discount it by less money to get into today's dollars. The other thing that we need to think about with these type of growth stocks is when interest rates are low, that gives them access to cheap capital to make those investments in new products and innovation that these companies believe will provide long-term price appreciation for their stocks. And just like the first point that we made, the opposite is also true. Anytime that interest rates rise, it becomes more expensive for the Googles, Apples, Facebooks of the world to invest in these new products for the future. So to keep it really simple, lower rates, it encourages companies to invest in themselves and the future, and higher rates makes that more difficult and more expensive for companies to accomplish. Lastly, we want to provide some historical context. Despite any articles or anything that you might hear over the next few months about interest rates rising, we do want to make it clear and remind you that from a historical perspective, rates are near all-time lows. You know, it's easy to forget, I should say, but the 10-year Treasury was yielding double what it is today just 10 years ago. And if you go back just a little bit further, we had double-digit yield in the 80s. So from a historical perspective, we're still in a good spot for growth as interest rates are still near the bottom of where they've been. The bond market is the largest market in the world, and it can move for inexplicable reasons, and the Fed ultimately has to deal with that. We agree with the Fed's view that the current bout with inflation and what they're anticipating in the future from an inflation perspective is transitory. So it's easy. The last year, it's been, at least for me, it's been interesting because in some ways it feels like it took about 5 years, and in other ways it's gone like that. But this time last year, there was little demand other than for food, and there was a lot of pent-up demand for toilet paper as we were entering the pandemic and beginning to understand what that meant. And now we are hopefully entering a point where there's going to be a boom in potential demand because we are hopefully leaving the pandemic behind sooner than later. So basically, we think that we experienced a temporary deflationary event, aka when the pandemic started and the country locked down and our economy was vastly impacted by that. And now on the flip side of that, we believe we're experiencing a temporary inflationary event where we're going to have this boom of pent-up demand now that we can hopefully get vaccinated and get out more than we have been the past year. Thanks for watching. Everybody stay safe out there, and I hope you all have a great week.